Hey guys, Toby Mathis here, and today we're going to go over 7 ways that you can get tax advantages when you're trading stocks. This is a big one for a lot of people, especially folks that don't have a ton of experience in the stock market because they don't understand what they can deduct, what they can't, what the rules are for when things are taxable, when they're not. And it seems kind of odd at times when a stock that you buy for, let's say, $100 and it goes up to $1,000 and you realize there are no tax implications to just holding that stock. And sometimes they're saying, well, how do I get access and benefit from it in the meantime? And also, if I am trading extensively and I'm doing programs, like I'm going to seminars, I'm going to conferences, or I have news feeds and I have my computer expense, I add 2 monitors, things like that, I can't write those off as an investor. What are my options so I can actually get deductions for things that are ordinary necessary for other businesses? Why can't I get that? And it's usually a shocker when they realize that you're limited. If you're an investor, you get to write off your interest expense. That's about it. And that's only if you're using margin, which I suggest you don't. Right. So you're going to have pretty much zero. We used to have some under miscellaneous itemized deductions, but the Tax Cut and Jobs Act did away with those, and no longer do we have any of those deductions as an individual. So you are literally left out in the cold with no deductions unless you do a few smart things. And so today we're going to go over 7 things that you could do. And I just want to go over them so that you have an idea of things that are out there. So I'm going to say 7. And we're going to start off with my favorite, which is how you actually structure a trading account. And there's 2 flavors to this, I'm going to say. But it's how you structure a trading account so you can write off your expenses. And a lot of folks, especially accountants, have no idea that it's this simple as what I'm going to show you. And they try to do something called trader status, where they say, change your whole life. You got to make your primary living out of the stock market. You got to do at least 750 trades a year. And you need to make sure that you're spending 70% of the trading days that you're trading, and make sure that you're doing 4 hours a day, and that it has to be substantial. And then you could write off your expenses, or you could even make a mark-to-market election, and then you could write off the losses as ordinary losses. And you're like, why would I be trading if I'm losing money? Like, what is this strategy that you speak of? But you don't have to worry about that. What I am going to show you is a simple workaround, and I'm just going to share my screen out, and I'm going to show you the way for over 2 decades, our folks have been doing this successfully in the stock market. And let me just kind of draw it up for you so you could see exactly how it works. So I'm going to call this one, I'm just going to write these up here. I'm just going to call it an LP Corp structure. And it looks like this. I say LP because it's easy for me to just remember. It's a limited entity, but I call it a limited partnership because I want the term partnership in there. But this little entity here that holds your stock, I'm going to put the little $ in there. This could be an LP, limited partnership, or an LLC. Doesn't really matter as long as it's a partnership. That's the big one. In other words, I'm just going to write partnership, and its partner is going to be either an LLC taxed as a corporation or a corporation. And this should be a C corporation, which just made a bunch of accountants' head explode. But don't worry. We've been doing this a long time, and I'll explain the rules to you. Probably not in great detail today because I want you just to know what the structure is, but it works like a charm. And what we're doing is we're making the corporation either a 10 to 20% owner in that partnership. And what happens? Let's just say that you make $1,000. If the corporation is, let's say, a 20% owner, then 200 of it would come up here, and you'd take 200 of it down there. So you would end up with only $800 of taxable income that goes to you. There's you. And this $200, you say, well, what does it do to the corporation? Well, that's where you're writing off your expenses. That is a family office. And it's writing off things like your computers, your cell phone, your subscriptions to your data feeds, events, conferences like seminars, conferences, travel to those things. You could even write off a salary and put it into a 401k and never pay tax, right? There's all sorts, well, defer the tax in a 401k, but there are things that you could do to minimize. There's 280A, the Augusta rule, where you're getting money out. There's an administrative office in the home. There's all sorts of stuff that allows you to write that off. In fact, that's not going to be enough, right? If we only made $1,000, we had $200 up there. Then the second swing at this is there's something called a guaranteed payment. So let's say that corporation, regardless of what was being made, said, hey, I want to get paid $1,000 a month. Well, boom, we're going to have to pay the entire $800 up here. And now we have the entire amount up into the corporation that's using it for expenses. And maybe you owe it money now. But at the end of the day, you're not taxed on it. Now, if we did not do this, that entire $1,000 would have flowed onto your 1040 and been taxable. But I had all these expenses. It doesn't matter. IRS is not going to shed a tear for you. The fact of the matter is they look at you as an investor. And as a result, you're not going to get any expenses. They have investment expenses. I think it's 212 versus ordinary necessary business expenses, which is 162. How do we make the journey and get under the 162? You set yourself up as a business. And that's strategy number one. And it works really, really well. Hey, look, if you have questions during any of the stuff I'm talking about, just go down below and into the comments and write strategy. Just write strategy, just one word, and we'll send you a link so you can set up a time to talk to somebody absolutely free. And they'll explain whether this is right to you, for you. Like they can look at your situation and see if this makes sense, because it has to make sense, it has to make dollars and cents sense. So this is number one. And this is using a structure for the benefit of, hey, I want to make sure that I have basically a management organization with my trading. And by the way, this works great with your real estate. It works great with other investments. And if you know how the wealthy do it, they almost all have a family office. And this is how they do it. They use a corporation to run their affairs, and they put their family members on the board so that they learn how to trade. And I'll say that from a estate planning standpoint, this is also way better than just having things in your name. Although I advocate using a living trust, I still like to have my trading account so I don't have to distribute it when I die. If it's sitting there in an LLC corporate structure, the benefit is LLCs do not die. All you have to do is keep paying the annual fee, and the members can change. Just like, we have publicly traded corporations, and these corporations don't die. The owners change all the time. You see, I could buy shares, sell shares, and you got millions of shareholders in some of these companies. It doesn't matter whether one of those people passes away. You could do the same thing in your family so that it doesn't matter if you pass away. Those shares are covered underneath the trust, and all we're doing is switching around the owners. So it may go from you to your 3 kids. It may stay in the trust. It's just much, much simpler. So that's number one. And I'm going to call this the visible strategy, because the second strategy is this same thing, but I'm going to put it in Wyoming. And now you're invisible. And I know that's not necessarily a tax strategy, but it works like a charm. And the reason that we're using Wyoming and what we do is we use a Wyoming LLC. A Wyoming LLC taxed as a corporation as the partner. Or, and for those of you guys who are not familiar with LLCs, I have a ton of videos on them. But an LLC does not exist for tax purposes to the IRS. You tell the IRS how you want it to be treated. So an LLC could be ignored. Hey, ignore it. It's just me. It could be taxed as a partnership if there's 2 or more owners. So like in the case here where we have an LLC that holds the brokerage account and the partner is the corp, that means there's 2 owners, me and the corporation. So it can be a partnership. It could be an S corp. It could be a C corp. And it technically, it could be, really, I'll just keep it 4. It could be disregarded if it's just 1 owner. If it's 2 or more, then it could be a partnership. It could be a S corp or a C corp. And that doesn't matter if it's 1 owner, 2 owners, you could be a corporation. So in our case, we could set it up in your local state, And you could just use whatever your local state laws are. Or we could say, hey, in Wyoming, you have privacy. You don't have ownership information listed in the Secretary of State. And that way nobody can see that you actually own the brokerage account or that you own an entity that holds a brokerage account. No, that's not visible in the public record. Nobody sees it. I find that that's the secret sauce to never getting sued, is when nobody knows what you have. And we see that play out over and over again with our high net worth clients all the time. In fact, we had two siblings. One sibling was a client of a prominent LA firm, and then our client. And the funny part, our client was worth a little bit less than the other guy, his sibling. But they structured him in California, and you could see he was on all these entities. And there was a liability occurrence where they were both implicated as owners of a building. And they sued the heck out of the brother, and they let our guy off for almost nothing. And and the reasoning was that they didn't think he had deep pockets. And it was just one of those funny situations where you're like, not funny, it's a horrible situation. There's a lot of liability, and literally took the other brother 4 years to get through it, a 7-figure settlement. But in our case, our guy got away very quickly and for a song, simply because they couldn't see what he owned. And that's how lawyers operate. They tend to want to go after people that have deep pockets. And this way, you're invisible. They can't see that you own it. And then even more importantly is, in Wyoming, they cannot take away your LLC or your corporation that you own. They can, if it's an LLC taxed as a corporation, they can't take it. There's a sole remedy in Wyoming, and that's called a charging order, which means they can get a lien against your entity. That is it. So if you have millions of dollars sitting in a brokerage account, and if you remember, I'll use a famous case. It was O.J. Simpson, right? And O.J. Simpson, if you have never heard of that case, just go Google it. You'll see enough on it to choke a horse. But the Goldmans sued O.J. Simpson, and they could not collect against him because he had protected assets. He had an NFL player's pension and a homestead that were protected. And I'm not saying, hey, this is great, go out and commit crimes and avoid responsibility. Hopefully, eventually they collect against something. But because he had statutory protections, they were unable to go and just force and take the money. And for frivolous suits, this is exactly what you want. For any suit, this is really what you want, because it's settlement negotiation period. But what it does is it makes it to where somebody cannot take away your assets. And you have statutory protections in this case, to where even if you did have a multi-million-dollar judgment against you, they couldn't take away your trading account. They can't take away your ability to supply yourself with a living. And that's really important, because you never want to be in a situation where an unjust suit or a frivolous suit takes away everything you own. So those are the top two that I'm going to talk about. And that's the structure. Real simple again. Looks like this when we draw it up. And I'm just going to use a corp and a partnership. And that could be an LLC, obviously. The cash is sitting here. Let's just say 20% to the corp, 80% to me. And I'd prefer that be you as a living trust, so that we never have to worry about probate. You do this structure, if you have a brokerage account and you put this in place, it's there for life, guys. It works like a charm. Third one, I want to talk about something called a health savings account. And the reason is because it's a triple threat. And when I say a triple threat, it is because you get a deduction for putting money in the HSA. And then you could trade like crazy. You could do all of your strategies, and you'll never pay tax on that. And so long as the money that you withdraw is used for health services or reimbursing yourself for health expenses, all the way back to when you set up the HSA. So think of it like this. I could set up the HSA today. I could trade in it for 20 years, and I could use none of its money to pay for any of my health expenses now. But in 20 years, I built up this big nest egg, and I could start reimbursing all my expenses that I've incurred all the way along. There's no rule there that says it has to be done contemporaneously, which means as long as I'm using it on health expenses, I never pay tax on any of the growth or any of those funds. So I get a tax deduction, tax-free growth, never have to pay tax again. So this is like a Roth IRA on steroids, because in a Roth IRA or a Roth 401k, you don't get a deduction when you put it in. You don't pay tax ever again, so long as you follow the rules, 5-year hold, be over 59 and a half. But in an HSA, as long as I'm using it for health, which we're all going to have health expenses, we all have costs. I can put money in there, deduct it this year in 2024, and it is $4,150 for a single, $8,300 for married. It's going up to I think it's $4,300 in 2025. And I think it's 85 here. I'm just going to look over here, 85.50 for a family. That's the amount that you could put in and take it as a deduction. And yes, the reason I put up 2024, I know it's 2025 and later, is because I could still make those contributions up till April the following year. So I just want you to know that even if you're watching this in January or February or March or whatever time in the future, know that this is very similar to an IRA where I could take a deduction for last year so long as I make the contribution by April 15th of the following year. I get a tax deduction, tax-free growth, never pay tax on it. And I can open an HSA at a Fidelity or a Schwab or whatever. I don't need to do any entities. I can just open it directly with the account. And can I have an HSA and an LLC account at the same institution? Yes. Can they be linked? Yep. Absolutely. Can I have a personal account there too? Yep. In fact, a lot of my clients bank primarily at brokerage houses because they understand there's a difference between the way a bank holds your money, which becomes the bank's money, and a liability. You become a liability technically. Your bank account is technically an asset of that bank. It's not the same way at a brokerage house. The brokerage house, they hold it in with a third party trustee, unless it's a bank at the brokerage. Like Schwab has a bank. But if you're doing a brokerage at Schwab, your money is not Schwab's money. It's not an asset on their balance sheet. It's your asset. It's kind of like having a safe deposit box, and they're much more secure. You don't have to worry about the failure of the institution because it's not mixed in with the rest of their assets. You get your money back no matter what. Although they will say that they have the SIBC. I think it's S. Forget the term, but they'll say they have insurance and these types of things. But the secret is that they're not actually mixing your money in with their other assets. At a bank, they do that. That's why you got to worry about bank failures. And don't worry, there's a bunch of videos on that too. Look at the one I did with Stefan Wetwill when the banks were failing, and he spells it out really, really well. All right, number 4, I already mentioned it, but then it's the Roth. And I tell people, do your Roth. What are we looking at? I think it's $6,500 or $7,000 you contribute to a Roth every year. If it's a 401k, technically we can get $69,000 into a Roth 401k. It's yes, you can actually do that. There's a strategy behind it. It's probably not at your employer. If you're self-employed, again, hang out with us a little bit, start spending some time on my channel, and you'll find it. But we call it a mega backdoor Roth. But that Roth, you get no deduction going in. But let's just say that I put $5,000 into that Roth, and it goes up to $50,000. So long as I do the rules, hold it, and take no distributions for at least a profit for at least 5 years, and I'm over the age limit, then when this money comes out, it's 0% tax, which means I avoided tax entirely. So if you're somebody who is just doing money aside for retirement, and you're just doing small amounts, and you say that LP Corp structure just seems a little bit big for me, then you may want to look at HSA and Roths because you're going to end up getting used to the money, but you're never going to pay tax on any of the growth of your stocks. So if your stocks, again, let's say I start at 5,000 and I invest consistently over a period of time, and it grows and grows and grows, and 30 years later I'm taking it out and it's quintupled or whatever it's done, and let's say it's gone up to $50,000, I have zero tax. And then the other thing is, and this is misunderstood, is that $5,000 I can take out anytime. So if you put money in a Roth, and you're a young person, for example, and you say, well, what if I need money? You can always take out the amount that you contributed tax-free and penalty-free. It's only the growth we have to worry about when it comes to tax. All right, number 5, loss harvesting. And the reason I'm saying this is because every year I run into this where people are not doing their loss harvesting on their stocks. And what it is capital losses, which is when you sell stock or crypto, it's considered capital losses offset capital gain. It doesn't matter whether it's long-term, short-term, you can just ignore all that. So if I have capital losses and I have stocks sitting there where they've gone down and I'm wondering what to do, like, oh crap, what do I do? You can always sell them, use that loss to offset any of your realized capital gains, and you'll pay no tax on those realized capital gains if the loss that you just took offsets it. A lot of people don't realize how powerful that can be. At the end of the year, you're looking at it going, hey, what should I do? It doesn't mean that you can't go get that stock back later. There's something called the wash sale loss rule, which says, hey, basically a 30-day one period, 30 days before and after of when you sold a stock, that you cannot be buying that same stock or substantially similar stock to cover the loss. But there's or that loss will actually attach to the new company that you purchased. So, and they're saying, hey, if you sell at a loss, let's say I sold Microsoft at a loss, and then I bought it back 2 days later, they don't let you take the loss you just took on Microsoft. They take the loss and attach it to your basis of what you just bought. Now, if you wait 32 days, you could do that. So if you're at the end of the year and you have losses and you're saying, geez, I should take some of these losses to offset my gain, and I'm not really interested in buying it back, okay, then just sell it and don't worry about it. If you want the stock back, though, there is a strategy, and I'll just explain it real verbally, but then I'll just tell you that it exists so you know that you could do it. There's a workaround for the wash sale loss rule, and that is as simple as this. I sell the stock, I buy an in-the-money option to buy it back. The loss will attach to that option, and then I buy the shares back. If you know how options work, they're going to be substantially less than actually buying the stock back. So you need to be able to do both. So I sell at a loss, buy an in-the-money option. The loss now attaches to that. It washes the loss of the previous sale, and now I have a much larger basis in my call options. And then I buy the shares. Voila, I now own the shares and I own the call options. When I sell the call options immediately thereafter, it has a higher basis and I take the loss on the option. That's all I do. I still end up with a loss. And since I'm buying in the money, I don't have exposure. It's not, the market's not going to move. So if I'm doing this, in 2 days or whatever, it's not really going to matter. It's not going to move. So this way I can grab my loss and use it against any gains I have, but I still end up owning the shares. So that's the workaround for the wash sale loss rule. It works like a charm. Number 6 is donations. And there's like a few different flavors, but I'm just going to give it to you like this. If I have stock that has appreciated, and I want a huge tax benefit without incurring it, do not sell your stock and then give money away. If you're somebody who tithes, if you're somebody who regularly gives, what I want you to do is earmark that money, put it in a donor advised fund, but don't sell it and then put it in a donor advised fund. Just transfer the shares into a donor advised fund. Call us. We actually have donor advised funds sitting empty, waiting for those funds. The Anderson has, I shouldn't say sitting empty. It has multiple brokerage accounts where you can roll shares into it and take control of it. You get a deduction based on the fair market value. So let's go back to our example where we had the Roth at $5,000, it becomes $50,000. Let's just say that was you individually. You paid $5,000, but your deduction when you donate it is worth $50,000. Do not sell it and then donate it. Donate it, then sell. And the reason being is because your taxes, when you sell inside of a donor advised fund or a charity, like you might have your own charity that you have attached to it, that you have maybe a private foundation or a public charity that you operate. That's something that's important to you. Donate your shares, because the donation is, so long as you held it over a year, I should say it has to be at least held for a year if it's a capital asset, then it's its fair market value. And so here we have fair market value in stocks because it has a readily identifiable market. We don't even have to get an appraisal. You get a $50,000 tax deduction. Huge. That can help offset all your other gain and your other any other income you have. Heck, it could even lower your W-2. I have zero taxable implication from the sale of those shares once I sell it inside the charity or the donor advised fund. I could even trade that money and make that $50,000 into $500,000, and there's no tax consequence to me. And I'm still giving that money to either a third party charity or one that I create and set up. It ends up working out great. But the principle is donation of appreciated assets. You get a deduction at its fair market value. Number 7, last one, and I'm just going to write up these things, is SBLOC. For those of you who know, you already know. For those of you who don't, remember we bought our stocks at $5,000 and they've gone up to $50,000, and you say, geez, I really need some cash to buy a car. With a security-backed line of credit, the brokerage house will loan you money secured by those shares. And that loan is taxed at 0%. Loan proceeds are not taxable. The wealthy do this all the time. They buy and accumulate shares of companies or other appreciated assets, and they borrow against them. In this case, it's called a security-backed line of credit. And yes, I do this. It's how you lever up. I don't want to sell when my companies have gone up in value over the years. I don't want that taxable event. I don't want to sell and have capital gains, even though capital gains in theory are taxed significantly less than ordinary income. You know, my top tax bracket as an individual is 37%, plus my state capital gains, long-term capital gains, the highest bracket is 20%. But then you have the net investment income tax, Obama charge, whatever you want to call it. It's a 3.8% plus my state. So it's really 37% versus 23.8 as the top brackets. Obviously, you're going to want that long-term capital gains rate, but I would still prefer 0. And when I borrow money, it's taxed at 0. And all I'm doing is using my securities. I still own them. And I just use them to back that loan. And it works like a charm. Folks that use it again, you could live off of this. I have substantial stock holdings, or maybe I was a founder of a company that went public. You see folks that do this and they just borrow against it. And here's the secret sauce. You ready? This is some of you guys, your minds are going to explode. When you pass away, the basis of those stocks goes to its fair market value. So if you passed away the day after you made that loan, your family could sell those stocks for $50,000 and pay 0 tax. It would be used partially to pay back your loan. Let's say you borrowed $25,000 to live off of. Hey, I borrowed $25,000. If I had sold that, I would have had $45,000 of gain at whatever my tax bracket was. Maybe I'm in the highest bracket, so 23.8%. So I'm paying, about a quarter of it away. So I'm paying over $10,000 in taxes. Here, if I borrow against it and then I pass away, I pay 0 tax. 0. And when it's $50,000, that's one thing. When it's $500,000, it's even more remarkable. When it's $5 million, it's extraordinary. The amount of savings. You're going to save over $1 million. That's why the wealthy use that security-backed line of credit, and you can too. Now, I went over 7 different strategies, and here's the thing. I don't expect you to remember them all. Just go down into the comments. And number 1, if you want to talk to somebody to see if any of these apply to you and how it might work with you, just type in the word strategy, and we will send you a link where you can schedule free consult. If you have comments, go ahead and put them down there as well. And if you think I missed any and you want to highlight something, or you think I'm all wet, please put it in the comments. And for all of you, please like and subscribe. It helps the channel out a lot. And if you know anybody that would benefit from this information, please feel free to share it. Good luck and God bless.